Okay, good morning once again. Um, Today is our second lecture, the lecture day 2. We started last week Saturday, physically in the class, but due to the constraint that we have at the lecture center, we couldn't afford to meet one-on-one today, and that's the essence of this online class. However, I will take my time to just explain what we did last time, a brief explanation on what we did last time before we move to the lecture of the day, so that those that miss what we did will be able to at least to gain one or two things. All right. So we started with cost of capital in our first day lecture, and then we said that cost of capital represents the compensation required by the providers of capital from their investments in a company. All right. So when you talk about providers of capital, there are those category of investors that have put up their resources to finance the operation of the company, like shareholders, like preference shareholders, and like also like debt holders. These categories of investors, they pull up their financial resources to finance the operation of the business. So they're expecting a return on their investment from the company. Okay. For example, the ordinary shareholders are expecting dividend payments. They are expecting to receive dividend from the company. So that dividend that the company will pay to the shareholders is a return to the shareholders, but it's a cost to the company because it's a cash outflow. Money will go out to those shareholders. Also, the preference shareholders as well as the debt holders. The preference shareholder will be expecting fixed dividend from the company, while the debt holders are expecting a fixed interest expense, fixed interest from the company based on their investments. Okay, so this is what is called cost of capital. We also mentioned that there are two key importance of cost of capital. One is to evaluate a project. Cost of capital is used to evaluate a project. So when a company wants to ascertain financial viability of a project, when a company wants to embark on a project, there will be need for the company to appraise the project to ensure that the project is financially viable. So as a result, you will need cost of capital to discount the future expected cash flow that will be generated by the project. So without the cost of capital, you won't be able to determine whether the project is financially viable using relevant investment appraisal techniques like net present value, project duration, profitability index, adjusted present value, or internal rate of return. So any of those techniques, you need cost of capital to discount the cash flow. Then two, the second importance of cost of capital is to determine the debt equity proportion that the company should carry in the capital structure, because each source of finance has its own underlying cost. So company wants to ensure that at all time, the company wants to ensure that it maintains the ownership structure of the business, because if a company finances operation with more of debt, it means that the company will be exposed to financial risk. The company may be exposed to financial risk because if the company fails to pay back the debt, the debt holders may take over the company because you have more of debt in your balance sheet. And that's why it is important at all time. Company management must ensure that the ownership and control of the business is maintained. All right. So, and then of course there are three major sources of long-term financing, including ordinary share capital, preference share capital, and debt capital. Each this source of finance has its own underlying cost. For example, the ordinary share capital, the cost associated with ordinary share capital is we call it cost of equity. The cost associated with preference share capital is called cost of preference share. The cost associated with debt capital is called cost of debt. So all of these things is what we want to look into in details. All right. So we discussed this last time. We started with, and I also mentioned to you that there are three categories of cost of capital. When you have to calculate cost of capital, because you must be certain which kind of cost of what kind of cost of capital do you want to calculate? Is it cost of capital using traditional method? Is it cost of capital using project specific, or is it weighted average cost of capital of the combined activity? Because each of them has its own way, a peculiar way of determining, of estimating it. So we now started with traditional weighted average cost of capital. We said when calculating traditional weighted average cost of capital, you must first of all calculate or compute the cost of individual source of financing. Okay, say for example, in the balance sheet of the company, you have ordinary share capital, you have preference share capital, you also have debt capital in form of bond or debenture or loan notes. So which means that you need to first of all go ahead and calculate what is cost of equity, what's cost of preference share, what's cost of debt. So once you are now done with calculating those cost of capital, you can then go ahead and calculate the overall cost of capital, which is the weighted average cost of capital. So last week, we started with cost of equity. I explained to you what cost of equity is all about. We said cost of equity represents the minimum required rate of return expected by the ordinary shareholders from their investment in a company. Okay. And now we said that cost of equity can be calculated in 3 ways, depending on the information given in the question. The first method of calculating cost of equity is dividend valuation model. The second one is capital asset pricing model. And the third method is Miller and Modigliani formula. So I now mentioned that the capital asset pricing model is a topic on its own. When we get to capital asset pricing model, we are going to discuss it in detail. Then I also mentioned that the Miller and Modigliani formula will be used when we get to when we get to adjusted present value. Okay, when we get to adjusted present value, we are going to use the formula of Miller and Modigliani to calculate cost of equity. Then last week we now focused on the dividend valuation model. Okay, and then we said calculating cost of equity using dividend valuation model, we said the cost of equity will represent the ratio or the relationship between dividend and the XDF share price. I will repeat, using dividend valuation model, cost of equity represents the relationship between dividend and XDF share price. So it is calculated as the ratio of dividend to exit share price, depending on whether dividend is growing or the dividend will remain constant to perpetuity. So I demonstrated the formula that you can use to calculate cost of equity using dividend valuation model where there is constant dividend, and secondly, where there is growth in dividend payment. Not only that, we also discussed the meaning of cum div and XDIV share price, because these are the underlying principle you must understand. No matter how big is the question, once you understand the principle, you have no issue. You are going to be fine. So, and now I mentioned that at all time, when you are calculating cost of equity, you need XDIV share price. If you are given cum div share price, you must convert it to XDIV share price. And I said that the cum div share price represent the share price that included dividend. And you don't use the share price that included dividend to calculate cost of equity. Rather, it must be XDIV share price. So if you are told in the question that the dividend is still outstanding, or the dividend is yet to be paid, or the dividend will be paid in whenever, so provided the dividend is still outstanding, it means that the share price given to you is cum div share price. So what this simply means is that you need to go ahead and convert the cum div share price to XDIV share price. How do you do that? The cum div share price is simply the XDIV share price is simply the cum div XDIV share price is simply the cum div share price minus the current dividend. Okay, minus the current dividend. So that is how to calculate XDIV share price, because you don't use cum div. You don't use cum div share price. And I mentioned the cum div share price is the share price that included dividend. So you don't use the share price that you must have paid the dividend before you calculate your cost of equity. So if cum div is given to you, this is the formula you are going to use to convert it to XDiv share price. That is the formula. Okay, that's one. Then again, we talk about growth rates. Another principle you need to take into consideration under cost of equity is calculating growth rates. Ordinarily, the shareholder will expect that their dividend received or the dividend payments will increase year on year or over time. Because as a rational investor, I don't expect that the amount of dividend I received last year is the same thing I'm going to receive this year due to prevailing economic circumstance. Because if I'm paid 10 naira per share last year, I expected that should have increased to 12 naira this year, because the level of inflation last year is not the same thing right now. Okay, so the management should have factored in that increase in the share in my dividend payment. So in that case, there will be growth in dividend payment. In the question on the day of your exam, examiner may not mention that the dividend will grow, or they may not give you the growth rate, but the information given in the question will dictate to you what you need to do. It is implied. All this information you must be able to deduce, must be able to imply from the question, to infer from the question what examiner is trying to communicate to you, because there's not at all time that examiner will make it very explicit. No, you must be able to deduce and infer from the question what the direction that the examiner is going. So I mentioned to you that there are two methods of calculating growth rates. One is historical pattern of dividend payment, or what we call averaging method, or the second one is Gordon growth. Okay, and we said that when the history of dividend payment is given in the question, when you are given the history of dividend payment, then it means that you are supposed to calculate your growth rates using averaging method or historical pattern of dividend payment. Again, if in the question you are given information on earnings or profit after tax and the capital employed, you can see in the question, you can see profit after tax. Profit after tax is the same thing as earnings. So if you can see profit after tax in the question, as well as the capital employed, you need nobody to tell you that you are supposed to calculate growth rates using Gordon growth model. So all these things are what we discussed in our last class, and I think that's where we stopped. We just solved about two short examples just to demonstrate the point. Please confirm to me, for those of you that were present in the class last week, where did we stop? Where did we stop? Yes.
Calculating market value.
Pardon?
Ozil PLC. That's what.
Calculating market value.
Okay, calculating market
Ozil
value.
PLC.
Okay, we solved the question of Ozil PLC, right?
Yes.
Okay, all right then. Now, I also explained how to calculate market value, even though I'm still going to explain that again when we get to calculating weighted average cost of capital. I will explain further when we get there. But for now, let's keep it on hold, the calculation of market value. Now, so we had short examples to demonstrate our discussion in class. Then we solved the question of Ozil PLC. So this is the question we solved last week. And so we did that. I think we had, did we have another one or just Ozil that we solved? Yes. Is it just the Ozil question that we solved, or we solved another one?
Just Ozil, sir.
Okay, let's have another one.
Just Ozil.
Okay, let me stop sharing. Let me stop sharing this. Let's have another one. Okay, let me try and say stop sharing first. Let me pick one point. Yes, this is good. Let's use this one. Okay. Let me share my screen with you. Let me know if you can see my screen, please. Can you?
Yes, we can see, sir.
Okay, so let's have this short example. Let's have this short example. Okay. Morino PLC is financed entirely by equity. The company has 150,000 ordinary shares of 1 naira each, currently quoted at 3 naira 42 kobo ex-div. So as I'm reading, once I see ex-div, examiner has told me that this share price of 3 naira 42 kobo exclude dividend. So that means I don't need to make any adjustment again. The company's current dividend of 6,158 naira was paid recently. So I have a current dividend of 6,158 naira. So our examiner also told me that this dividend has been paid. So that means, of course, like I said, the 3 naira 42 kobo is already ex-div. Then we're now told that okay, the company's current dividend of 6,158 naira was paid recently out of the company's earnings of 62,858 naira. So I'm giving honey. As I see these earnings, something should come my mind that, okay, there's likelihood that I'm going to calculate growth rate in this question because the examiner has given me earnings. Once I have this earnings, something should cross my mind that, okay, I may need to calculate growth rates using Gordon growth model. Because under Gordon growth model, you use Gordon growth model if you are given earnings and capital employed. The capital employed of the company is 315,000 naira and a dividend of 2,473 naira was paid 5 years ago by the company. So in this question again, I can see capital employed of 315,000 naira, which means that I'm going to calculate growth rates using Gordon growth model. Using Gordon growth model, because in the question I have earnings of 62,858. I also have capital employed of 315,000 naira. So that means I will calculate growth rate using Gordon growth model. In the question, examiner also gave to me the history of dividend paid. The historical pattern of dividend payment will also be used to calculate the growth rate because in the question, examiner has told me that a dividend of 2,473 naira was paid 5 years ago. That's the history. The amount of dividend that was paid five years ago was given to me as 2,473 naira. So since examiner has given me the information, the history of dividend paid 5 years ago and the current year dividend, it means that I'm also going to calculate growth rate using the historical pattern of dividend payment. So which simply means that I'm going to calculate two different growth rates using the two methods. I will calculate growth rates using Gordon growth model. I will also calculate growth rate using historical pattern of dividend payment. So the implication of this is that you are going to calculate two different costs of equity because examiner was not specific. Look at, you are required to calculate the company cost of equity capital. You only have to calculate the company cost of equity capital. Which one are you going to use? Do you want to use the Gordon growth or you want to use the historical pattern? Because the examiner was not specific, then you are going to calculate the two together. That's the implication. So with this, I will then go ahead and solve the question. Okay, I'll just go ahead and solve the question. Let me see if I can use this one. I'll just go and let me use, okay, let's use this one to just explain. It's just, we're testing the principle. Now, if I now want to calculate my cost of equity, so two things I'm going to do. First thing first, I need to go ahead and calculate my growth rates. Okay, I need to, because in this question, there is growth. Where examiner did not tell me that there is growth in the question, but based on the information given, I know that there is growth and then I need to calculate the growth rate. So if I want to calculate the growth rates using historical pattern of dividend payments. If I want to calculate growth rate using historical pattern or averaging method, historical pattern, okay, if I want to use historical pattern, of course, because examiner has given me there are two formulas I provided for you last week for calculating growth rates using historical pattern. And I said that where the history of dividend payment is given year on year, every year, the history of dividend pay for each year are given. For example, in the example that we solve in the class for OZ PSC, this is the same question, but here is called party. So when you can see in this one from 2017 to 2022, you will notice that the history of dividend paid from that year is given as 15, 18, 20, up to 30. So when you are given the history of dividend payment year on year, then your growth rates will be calculated as n minus 1 into latest dividend, that is the current year dividend, minus the dividend paid in the first year, all minus 1, okay? N minus 1 divided by, equal to, into square root latest dividend divided by the dividend paid in the first year, all minus 1. So when you are given the history of dividend payment in this format, in this form, this is the formula you are supposed to use to calculate your growth rate. But when you are given the history, you are given the history of dividend payment, you are given the dividend paid in the first year and the current year dividend. In that case, you cannot use this one, but rather the growth rate will then be equal to n into latest dividend plus dividend paid in the first year, all minus 1. So this is the formula that you are going to use, where the current year dividend and the dividend paid in the first year are given in the question. So you can see there is difference between the two. This one that I cycled is only used when the history of dividend payment is given year on year, like in this case. I believe that is clear. So going back to the question that we are solving, in this case, examiner did not give me the history of dividend payment year on year. I'm only given the dividend paid 5 years ago in the first year, and then the current year dividend. So in that case, my G would then be equal to n into latest dividend divided by dividend paid in the first year, all minus 1. So equal, I can rewrite this. I can then say n is equal to 5 because 5 years ago, that's n is 5. So I can then say latest dividend is the current year dividend, which is 6,158 divided by dividend paid 5 years ago is 2,473. Okay, 2,473. Let me write that. Okay. What's wrong with you? So 2,473. So I can rewrite this formula to say just mathematically, n is equal to 5. I'll just say raised to power 1 over 5, all minus 1. Therefore, my G will then be equal to, you bring out your calculator. 1 divided by 5 is equal to 0.2. Therefore, we say 16158 divided by 2473 equal, then raised to power 0.2 equal minus 1 equal multiply by 100% equal, that's 20%. So growth rate is equal to 20%. I believe you got the same thing. Please try it with your own calculator so that we'll be on the same page. Did you get 20% as I did?
Yes, sir.
All right, thank you, Timileyin. Okay then, so I will then go ahead. You can see I've calculated the growth rates using averaging method, which is 20%. I also need to calculate growth rates using Gordon growth model. So using Gordon growth model, let me use this space. I have the working down there, but I just want to demonstrate for you so that you see the way we are doing it, not the prepared solution. So using the Gordon growth model, I will then come here, Gordon growth. Okay, using the Gordon growth model. Why am I using Gordon? Since I've calculated growth rate using averaging method, why should I calculate for Gordon growth again? I've explained the reason, because in the question, you are given information on earnings of 62,858. You're also given information on capital employed, 315,000. So all the information are there. So I would then say, G, using Gordon growth rate is calculated as return on capital employed, return on capital employed multiplied by retention rate. R is the return on investment or return on capital employed. B is the retention rate. Therefore, I need to go and calculate first. I will come back here later on. So I need to go and calculate first the return on capital employed. Therefore, R, return on capital employed, is earnings divided by capital employed. Okay, divided by capital employed, or multiply by 100 over 1. So I will go back to the question. What's the value of the earnings? We are told that earnings is 62,858. 62,858. Then divide by capital employed. According to the question, capital employed is 315,000. Here is 315,000, or multiply by 100 over 1. So finally, R will be equal to 62,858 divided by 315,000 equal, multiply by 100 equal, that's 19.95, that's 20%. Okay, so return on capital employed is 20%. Then I need to calculate the retention rate. The retention rate, depending on the information of earnings given to you, that will depend on the formula that you are going to use. I gave you about 2 or 3 formulas for calculating your retention rate. But in this question, since our earnings are given to us in absolute number, therefore earnings minus dividend minus total dividend divided by earnings multiplied by 100 over 1 will give us the retention rates. So retention rate equal to earnings is 62,858 minus dividend. How much was current dividend? The current dividend is 6,158 naira. So here is 6,158 divided by 62,858 multiplied by 100 over 1. So bring out your calculator. I would then say 62,858 minus 6,158 equal, that's 56,700 divided by 62,858. Excuse me, 858 equal, then multiply by 100% equal, that's 90%. Here is equal to 90%. So if retention rate is 90%, that means we are paying out 10% as dividend. We are paying out 10% as dividend. So I have my return on capital employed to be 20%. Here would then be 0.2. Okay. I'll just say 20% multiplied by 90%. That will be 18%. Here is 20% multiplied by retention of 90%. That's 18%. So this is how to calculate growth rates using Gordon growth model. So because we have 2 different growth rates, we use Gordon growth. We got 18%. We also use a historical pattern of dividend payment. We got 20%. So in this case, we need to go and calculate two different costs of equity. So at this point, I will just go ahead and calculate my cost of equity. So how do I get my cost of equity? I have two options to calculate my cost of equity. I can either use absolute number or I use par value to get my cost of equity. Whichever one that I use, I'm going to get the same answer. Now, using historical pattern of dividend payment to calculate my cost of equity, this is what I'm trying to say, what you have here. So I will go to the question. Since I already have there is growth rate in this question. Therefore, to calculate my cost of equity, the current dividend multiplied by 1 plus the growth rate divided by XDIV share price plus the growth rate, all multiplied by 100%. That is the formula for calculating cost of equity where there is growth in dividend payment. So at this point, I can either use absolute number, okay? I can either use absolute number, like in this case, or I use par value, like in this case. So whichever one I use, I'm going to get the same thing. Absolute number in the sense that because in the question, the current dividend given to me is an absolute number. 6,168 naira is an absolute number. But the share price, the XDIV share price given to me is par value, that is 3 naira 42 kobo. So I cannot use 3 naira 42 kobo in one instance, and then I'll go ahead and be using absolute number for dividend. So I have to use apple for apple, orange for orange. So if I want to use absolute number, in that case, I will maintain the current dividend to be 6,158 naira. But for the denominator, I need to convert the share price of 3 naira 42 kobo to total market value. So how do I get the total market value? I'll just multiply the XDIV share price with the number of shares. Number of shares in this question is 150,000 shares. Okay. This is the number of shares as given to us, 150,000. What is that again? Yeah, this is it. 150,000 is the number of shares. So I would then multiply the current market price per share of 3 naira 42 kobo with the 150,000. So that's what gave us the 513,000. So I would then carry my calculator, 6,158 naira multiplied by 1.2 divided by 513,000 equal, then plus the growth rate of 0.2 equal. Then, of course, final answer is 21%. That's how we got the 21%. Please, you have to be very careful when you are calculating this, because you have to follow BODMAS. Remember what I said. The growth rate is 20%. 20% plus 1, that's 1.2. So 1.2 multiplied by 6,158, then divided by 513,000. Okay, equal, then plus 0.2, equal, multiplied by 100%. That's how we got the 21%. Please try it on your own. Then, alternatively, if I don't want to use absolute number like in this case, I can use par value. My XDIV share price of 3 naira 42 kobo is par value, but the dividend given to me is absolute number, it's not par value. So if I want to use par value, I need to go ahead and convert the total dividend of 6,158 naira. I need to convert it to dividend per share. And you know, dividend per share is calculated as total dividend divided by number of shares. So in this case, the total dividend is 6,158 naira. Number of shares is equal to 150,000. 150,000 shares. When you do this, the final answer is 4 kobo. Okay, the final answer is 4. So dividend per share is 4 kobo. So now that I have the dividend per share, I can proceed to calculating my cost of equity. Therefore, the dividend per share, the current dividend per share is 4 kobo multiplied by 1.2 divided by 3.42 equal plus 0.2 equal multiplied by 100% equal. That's what gave us that 21%. So you will notice that the same 21% you have when you use absolute number is the same thing you have when you use the par value. It's the same. Then that is using the historical pattern of dividend payment method. Now, I need to go ahead. Secondly, I need to go ahead again and calculate the cost of equity using the Gordon growth model. Therefore, I've already calculated the growth rate under Gordon, which is 18%. Look at the 18% we got here. That's 18%, the one I cycled there. That's 18% using the Gordon growth. So I'll just do the same thing. It's the same formula. Using, in this case, I use absolute number when we arrive at 19%. If I want to use par value, what I will just do, I will say cost of equity equal to, is the same formula we are using. Par value, dividend per share. The current dividend per share is 0.04. Okay, multiply by 1.18 because growth rate is 18%. So 18% plus 1, that will give us 1.18. Then divide by XDIV share price. XDIV share price is 3.42. All plus growth rate of 18%. Multiply everything by 100 over 1. So we should have the same thing as 19%. Okay? So if I want to use par value, this is what I will do. All right? So that is the end of the question. Of course, all the workings are also here. So you can see them one by one. We have done it previously up there. So let me know if you have any question for me so that we can move to cost of preference share. Any question?
Okay, can you hear me, sir?
I can hear you.
Okay, sir. So based on this computation now, so will there be any notes to the computation that we've done so far? Like giving a decision, like a note to the computation?
No, there's no point. All you need
Okay,
to do is just show your, in the question on the day of the exam, just show your working. See, examiner is asking you what is the company cost of capital. After your computation, the only thing you just say is that the company cost of capital under historical pattern of dividend payment is 21%, whereas under Gordon growth model, it is 19%. That's all. Then you show your workings. That's all you need to do.
okay, sir. Thank you, sir.
You're welcome. So at this point, let's go to cost of preference share. Let's go to cost of preference share. Okay. For the cost of preference share, remember where we started from. We are driving to how to calculate weighted average cost of capital using traditional method. So we started with cost of equity, and we just completed cost of equity now. So the second one is cost of preference share. So let's talk about preference share, how to estimate cost of preference share before we move to cost of debt. All right. So let's take it step by step. So when it comes to cost of preference share, first thing first, the cost of preference share is the compensation required by the providers of preference share capital, okay, from their investment in the company. The preference shareholders are entitled to fixed dividend from the company, and they will be settled in the event of liquidation. The preference shareholders will be settled before the ordinary shareholders after the debt holders might have been settled. Okay, so what that means is that in the order of settlement, the preference shareholders is ranked over ordinary shareholders. Okay, the preference shareholders are ranked over the ordinary shareholders. However, there are cumulative preference shares, there are cumulative, non-cumulative, participating, non-participating, redeemable or irredeemable preference shares. When it comes to cumulative, non-cumulative, participating and non-participating preference shares, they are purely theoretical, nothing like calculation. The only area you are going to have calculation is under redeemable and irredeemable preference share. But however, what do you mean by cumulative preference share? What do you mean by cumulative preference share? The cumulative preference share is a kind of, for example, when you in the profit or loss accounts, after you have paid the tax, you are going to have profit after tax, which is what we call earnings. We are going to have profit after tax. From that profit after tax, you need to settle the preference shareholders first. You must pay the preference dividend before you consider ordinary dividend, okay, from the profit attributable to the owners of the business. However, when it comes to cumulative preference share, where a company does not have a profit available to pay the preference dividend can be carried forward until the company is able to make profit to settle the preference shareholders. Say, for example, in the first year, a company make loss. In the second year, the company also make loss. But in the third year, the company is able to make some profits. So the preference dividend the company is supposed to pay in the first year, which was not paid, will be carried forward to the second year. You are going to add it to the one you are supposed to pay in the second year. Then in the third year, plus the preference dividend you are supposed to pay in the third year. So whatever the amount of profit that is available in that third year, you deduct the outstanding preference dividend first. If you have any balance that are yet to be paid in the preference dividend, you carry it forward. So that's why it is called cumulative. You'll be adding it year on year until the company is able to make profit to pay the preference dividend. So that's why it is cumulative. But for non-cumulative preference share, the company can, once the company does not have profit to pay, then you can't carry it forward. That means the preference shareholder will forfeit it. We forfeit the profit in that particular year. So that means you can only pay preference dividend when there's available profits to pay. So that's the meaning of cumulative preference, cumulative or non-cumulative. So let's talk about, like I said, the one that involves calculation is the redeemable and then irredeemable preference share. So what do you mean by redeemable preference share? Please, this is not physical class. If I'm too fast, let me know. If I'm too slow, also let me know so that I can make appropriate adjustments. So, what do you mean by irredeemable preference share? The irredeemable preference share simply means that the company will pay annual fixed dividend to perpetuity, but the principal will not be repaid. I repeat, for irredeemable preference share, it means that the company will pay annual fixed dividend, but the principal will not be repaid. Say, for example, if an investor or if a company invests 1 million naira in another company in preference share with the hope of getting 10% dividend every year. So what this simply means is that the preference shareholder will only be receiving that 10% fixed dividend, but the principal amount that the preference shareholder has invested, that 1 million naira, will not be returned to the preference shareholders. So the preference shareholder will only be receiving 10% fixed dividend for the foreseeable future. So that's the implication of irredeemable preference share. But for a redeemable preference share, a redeemable preference share arises whereby the company is expected to pay annual fixed dividend and the principal at the maturity date. Let's say, for example, the preference share is for maturity of 5 years. So it means that every year the company will be paying preference dividend, okay, until the final year. On that final year, they are also going to pay the preference dividend and the principal sum, okay, at the maturity date or at the redemption date. So that's the difference between the two. I will repeat again. For irredeemable preference share, the company will only pay annual fixed dividend, but the principal will not be repaid. For redeemable preference share, the company will pay both annual fixed dividend and the principal at the redemption date. That's different between the two. However, when it comes to redeemable preference share, the redeemable preference share can be redeemed at par, at premium, or at a discount. Okay, the redeemable preference share can be redeemed at par, at a discount, or at a premium. So all of this, you must take them into consideration. All right then. So how do you then calculate cost of irredeemable preference share? So the cost of irredeemable preference share simply is simply the ratio of fixed dividend to ex-div share price. I repeat, the cost of irredeemable preference share is the ratio of fixed dividend, KP, cost of irredeemable preference share is the ratio of fixed dividend to ex-div share price, or multiply by 100/1. Please, as far as preference share is concerned, the preference shareholders does not have voting power in the organization, in the company. The preference shareholder does not have voting power in the organization. And you can see the preference dividend that the preference shareholder will receive is fixed in nature. It doesn't grow. It is fixed. There is nothing like growth under preference share. So you have to take note of that as well. So if I want to cut, this is the simplest way. Now, when you want to calculate the cost of irredeemable preference share, it's just the ratio of fixed dividend to ex-div share price. All the principles that you discuss under cost of equity in relation to cum div ex-div share price, they still apply here. You have to take them into consideration as well. So because at all time, your denominator must be ex-div share price. So if cum div share price is given to you, you need to convert it to ex-div share price before calculating your cost of irredeemable preference share. So it's the same formula that you have here. It's the same thing. The D is the fixed dividend. The market value of the preference share is the ex-div share price. So it's the same thing. All right. So let's have a short illustration to demonstrate this. Let me see. Now, so that will be consistent with the material you have with you. Let me see. Yes. So when you go to the material which I shared with you on page 11, illustration number 2. On illustration number 2, which is Adenine PLC. Okay, Adenine PLC. So I need somebody to read, please. So I want to be sure that you guys are following me. I won't be the only one talking. Yes, who's reading for us?
Okay, I'll go, sir.
Thank you, Ganiat.
Okay. Adeline PLC has an issue preference shares with the nominal value of 25 kobo. The agreed dividend of 5K has just been paid. Required, what is the cost of preference shares?
Thank you very much. So in this requirement, examiner is asking what is the cost of preference share. So at this point, I need to ask myself, what kind of preference share? Is it redeemable preference share or irredeemable preference share? So it will be the preference share will be redeemable if and only if the redemption date is given. But as far as this question is concerned, we don't have redemption date, so you ignore. So it means that it has to be irredeemable preference share. So in this case, the cost of irredeemable preference share is the ratio of fixed dividend to ex-div share price. So I will then go to the question, what is the fixed dividend given to me? I will go and look for dividend given. So we are told in the question that the agreed dividend of 5 kobo has just been paid. So my KP, cost of preference share, is equal to dividend divided by ex-div share price. Okay, ex-div share price multiplied by 100/1. So in this case, my dividend is 5 kobo. The ex-div share price, we are not given share price, so we are given nominal value. Nominal value is the same thing as book value or face value. So that is the amount you have in your balance sheet. That's the face value, that's the nominal value. So since you don't have market value, then in that case, nominal value will represent. So divide by 25, multiply by 100/1. So this should give me the final answer. So that's it. That's what the examiner is asking you, and that's what you have at 20%. Okay. If I like, I can say It's the same thing if I say 5 over 25. It's not compulsory. I must put, because the numbers are in kobo. 5 divided by 100 will give you 0.5. 25 divided by 100 will give you 0.25. But it's a waste of time. Just say 5 divided by 25. You get the same answer. Move on. All right? Okay, then. So that's the question. So this is how to, I doubt at this level if examiner will be asking you to calculate cost of irredeemable preference share, because it's very simple and straightforward. It's very simple and straightforward. The essence of what we are doing is just to test the principle, okay? To test the principle, all right? So the next one is the cost of redeemable preference share. Let's talk about cost of redeemable preference share. Like I mentioned the other time, redeemable preference share is the one in which the company will pay both annual fixed dividend and the principal at the maturity date or at the redemption date. Okay? The preference share, the redeemable preference share can be redeemed at par, at premium, or at a discount. How do you then estimate cost of redeemable preference share? When you want to calculate cost of redeemable preference share, simply go ahead and calculate internal rate of return. All of us in this class, we have calculated internal rate of return. You have learned about internal rate of return previously. In fact, in your performance management capital budgeting, you did internal rate of return. So whenever you want to calculate cost of redeemable preference share or cost of redeemable debt, it's simply internal rate of return. What do you do when you want to calculate internal rate of return? Simple. You assume 2 discount rates that will produce 2 opposing NPV. Then step 2, you go ahead and calculate the internal rate of return. That's all. That's what is expected. One discount rate will produce positive NPV, another discount rate will produce negative NPV. Then you interpolate in the internal rate of return formula. That will represent the cost of redeemable preference share or cost of redeemable debt. So that is how to calculate cost of redeemable preference share. So let's have illustration to demonstrate that. So, of course, all these procedures is just to oversimplify the thing. That's why I went all this far. This is very straight. Just go ahead, assume 2 discount rates. Okay, one discount rate will give you a positive NPV, another discount rate will give you a negative NPV. Then you interpolate in the IRR formula. This is the formula for internal rate of return. You're already familiar with that formula. That's all you need to do whenever you want to calculate cost of redeemable preference share. And like I mentioned the other time, the preference share will be redeemable only if and only if the redemption date is given to you. The date that the company will pay back the principal sum is the majority date, is the redemption date. So if in the question you are not given the redemption date, then it's going to be calculated as cost of irredeemable preference share. Because without the redemption date, you won't be able to calculate cost of redeemable preference share. I hope that is clear. Move on to the next one. So at this point, let's have illustration to demonstrate cost of redeemable preference share. Yes, somebody should read, please. Who's reading for us?
Johnson PLC is financed with
Thank you.
1 million redeemable preference shares with a nominal value of 1 naira and a nominal rate of 8%, but currently quoted at 1 naira 5 kobo ex-div. The preference share will be redeemed at par in 5 years' time. Calculate the cost of preference share.
Thank you very much, Okwe. Now, in this question, the examiner is asking you to calculate the cost of preference share. Again, you need to ask yourself, what kind of preference share is this one? Is it redeemable or irredeemable? So in the question, the fact that the examiner mentioned redeemable preference share does not make it a redeemable preference share. So it can only be redeemable preference share if and only if the redemption date, in this case, the redemption date is 5 years' time. So if and only if the redemption date is given to you, that is only when you can say it is redeemable. Other than that, it will be irredeemable. I believe that is clear. So in this case, what am I supposed to do? This is redeemable preference share. I mentioned to you there are two procedures you are going to carry out, two key procedures. One is to assume two discount rates that will produce two opposing NPV. One discount rate will give you negative NPV, another discount rate will give you a positive NPV. Then step two, you proceed to calculating internal rate of return. That internal rate of return is the cost of redeemable preference share. It's as simple as that. However, in this question, there are three variables I must look out for in the question for me to be able to calculate my NPV. I'm looking for three variables. One is the current market value. The current market value of the preference share is number one item I must look out for. Secondly, I must look out for the fixed dividend. What is the fixed dividend that will be paid annually? Okay. From the question, I must get the fixed dividend. Then number three items I must look out for that will enable me to calculate my net present value is the redemption value. I will go to the question. I need to go and check how the preference share will be redeemed. Is it at par, at premium, or at a discount? So in this question, how do I get my current market value? I will go back to the question. The examiner has told me that the preference share currently quoted at 1 naira 5 kobo ex-div. So examiner has given to me the current market price of this current of the preference share to be 1 naira 5 kobo. So how do I do this? Do I want to use, at this point I need to ascertain myself, do I want to use par value, or I want to use the absolute number? If I want to use par value, it means that I don't need to do it. I just use my 1.05, the ex-div share price. Then in that case, my fixed dividend will be 8% of 1 naira. My fixed dividend will be 8 because your dividend, your preference dividend must be based on the nominal value. So the nominal value per share is 1 naira. The nominal rate is 8%. 8% of 1 naira will give me 0.08. So if I want to use par value, so it will be 0.08. But if I want to use absolute number, I need to multiply the market price per share of 1 naira 5 kobo with the number of shares, with the number of shares. Then the nominal rates also, which is 8 kobo, then I will multiply with number of shares. So that will give me 80,000 naira. Then the redemption value will now be the nominal value because it is redeemed at par. The par value is 1 million naira. That is 1 million shares multiplied by nominal value of 1 naira. That's 1 million naira. So if I want to use par value, I will be consistent with par value. If I want to use absolute number, I will be consistent with absolute number. But at the end of the day, the two will give me the same answer. I will get the same answer for the two. So I will go to the question. My current market value, if I want to use absolute number now, I will just say 1.05, 1 naira 5 kobo multiplied by number of shares, 1 million preference share. That will give me 1,050,000 naira. Again, for my fixed dividend, we are told that nominal rate is 8%. So 8% of 1 naira, that's 8 kobo multiplied by number of shares of 1 million, that's 80,000 naira. So I will say 8% multiplied by 1 naira, then multiply by number of shares, multiply by 1 million shares. Whatever the amount I have, I'll put it there. Then for the redemption value, we are told that to redeem at par in 5 years' time. So I need to calculate the nominal value. So the nominal value will then be equal to 1 million shares multiplied by 1 naira. That will give you 1 million naira. That's all you need to do. Once I have this, I will then go ahead. I will assume two discount rates. In this question, instead of having two different tables, this is oversimplification. Instead of having two different tables, table 1, then table 2, I can use only one table to get my answer. I will use only one table and I will get the same answer. That will save my time because it's the same cash flow. The only thing that is different is the discount factor or annuity factor. Therefore, I'm assuming here, I assume 5% discount rates. You can see the 1,050,000 that we got here, the current market value, 1,050,000 is what you have here. Of course, it has to be in brackets. The 80,000, 8% of 1 naira, that's 88 kobo. 8 kobo multiplied by 1 million shares, that will give me 80,000. My redemption value, 1 million shares multiplied by 1 naira will give me 1 million naira. This is what you need to do. Because I start with, when you are calculating internal rate of return, no examiner will give to you the discount rate that you are going to use. You are the one that we are assuming. That's why we say that internal rate of return is subjective. So you are the one that will assume the discount rate that you want to use. So at this point, I would then say, since my current market value is 1,080,000, so discount factor at year 0 is equal to 1. Therefore, 1,050,000 multiplied by 1 will give me 1,050,000. I will move to the fixed dividend. My annual fixed dividend is 80,000 naira. Year 1, 80,000. Year 2, 80,000. Up to year 5, the same 80,000. So instead of me to be doing it year 1, year 2, year 3, year 4, it's a waste of time. I will go ahead and calculate annuity factor. And you remember, annuity factor is calculated as 1 minus 1 plus r raised to power minus n, all divided by r. All of you are familiar with this formula. All right. So I will use that one to calculate my annuity factor of year 1 to 5. You only calculate annuity factor if your cash inflow is constant. So because this 80,000 naira is constant from year 1 to 5, that's why we went ahead to calculate the annuity factor of 4.329. Therefore, 80,000 multiplied by 4.329 will give us 346,320. Finally, in year 5, we are going to have redemption value. So and the redemption value is 1 naira because it is redeemed at par. So discount factor at year 5 at 10% at 5% is 0.784. 0.784 multiplied by 1 million will give me 784,000. Remember, NPV represents the difference between the present value of cash inflow and present value of cash outflow in capital investments. Therefore, I will add up the present value of the positive, I will add up the positive present value, then I will less the negative present value. The difference is 80,320. Now, that is one side. I will also go ahead, I assume 5%, I got a positive NPV of 80,320. I need to assume a higher discount rate that will produce a negative NPV. In this case, I will assume 10%. So the figures still remain the same. The figures remain the same. Therefore, of course, I need to go and calculate annuity factor of year 1 to 5 at 10%. When you calculate that, you are going to get 3.791. When you multiply 3.791 with 80,000, we have 303,280. Then discount factor at year 5. For year 5 at 10% is 0.621. Multiplied by 1 million will give you 621. When you add up the positive present value, with less negative present value of 1,050,000, the balance is 125,720. So that's a negative NPV. Now that you have a positive NPV, you also have a negative NPV. You can then proceed to calculate the cost of redeemable preference share, which is internal rate of return. So in this case, this is the formula for calculating internal rate of return. Just slot in the numbers, and the final answer is equal to 7%. That is the final answer, 7%. So these are the things that you need to take into consideration when you want to calculate cost of redeemable preference share. Like I mentioned the other time, I can decide, let me look for a bigger space. Yes, I can decide, instead of me to look at the workings I did up there, is the same thing you have here. So I've explained it before. So now, if I don't want to use absolute number, here I use absolute number. 1,050,000, 80,000, 1 million naira. So if I don't want to use absolute number, I can use par value, and we are going to get the same thing. Say, for example, if I want to use par value, I will come here. In this case, I will demonstrate for you how to use, instead of having 2 tables, just use only 1 table. So I can say, assume we are starting from 5%, for example. So I will then say, create a column for here. description of item. We have cash flow. Okay, cash flow. Discount factor at, I don't know yet. Then we have present value. Okay. Now, year 0, year 1 to 5, then year 5. Okay. So the essence of this is for me to just demonstrate for you how to use, if I want to use power value instead of absolute number. My NPV will be here at 5%. Okay. Then at 10%. Okay. That's that. Here is 10%. So this is current value. This is fixed dividend. This is redemption value. Okay, that's the redemption value. Now, if I want to use power value, okay, if I want to use power value, what am I supposed to do? For my current value, the XDiv share price is 1 naira 5 kobo. So here I will say 1 naira 1.05. Put it in brackets. My fixed dividend, according to the question, our dividend, the fixed dividend is equal to 8%. The nominal rate of the dividend that the preference shareholder will receive is 8%. So 8% of 1 naira will give me 8 kobo. Therefore, here I will come and put 0.08. Here is 0.08. Then the redemption value. Examiner told us that this preference share will be redeemed at par. At par means at 1 naira. Nominal value is 1 naira. Where is it again? Yes. Nominal value is 1 naira. Therefore, that's the par value. I will then come in and put 1 naira. So at this point, discount factor at year 0, 5% is 1. Here is also 1. 1 multiplied by 1.05 will give me 1.05. Brackets, 1.05, brackets. Then the annuity factor that we have calculated under 5% is annuity factor under 5% is 4.329. You remember 4.329. Here I will say 4.329. Okay. Then under 10%, annuity factor under 10% is 3.791. Annuity factor under 10%, 3.791. Here is 3.791. Discount factor under 5% is 0.784. Here is 0.784. Discount factor under 10% is 0.621. Therefore, let's carry your calculator. Let's do it together. In this case, I would then say 0.08 multiplied by 4.329 equal, that's 0.3463. Here is 0.34 or 35. You can do rounding. 0.35. Let me confirm from the calculator. Yeah, 0.35. So rounding 0.35. Then for here would then be 0.78. 0.78. Then the second one under 10% will be equal to 0.08. Excuse me. 0.08 multiplied by 3.791. 3.791 equal, that's 0.3. Here is 0.30. Okay, let me rewrite that. Then this one will be 0.62. So let's find the difference. I would then say 0.35 plus 0.78 equal minus 1.05 equal, that's 0.08, here is 0.08. Then the other one, 0.62 plus 0.3 equal minus 1.05 equal 0.13. Here is 0.13 negative. So in this case, I would then say my cost of redeemable preference share, which is internal rate of return, to be equal to, of course, you know the formula already. Okay, let me just write it out, which is lower discount rates plus the NPV of the lower discount rate over NPV of the lower discount rate plus NPV of the higher discount rate. All of this multiplied by higher discount rate minus the lower discount rate. Therefore, A is the lower discount rate, which is 5, plus NPV of that 5% is 0.08 divided by 0.08 plus NPV of higher discount rate of 10%, which is 0.13. So this then be equal to higher discount rate of 10 minus lower discount rate of 5. Therefore, I would then say 0.08 divided by 0.21 equal, multiply by difference between 10 and 5, which is 5, equal, then plus 5 equal, that's 6.90, that's 6.9%. So here is 6.9%, approximately. The cost of redeemable preference share is 7%. So you are at liberty to either use absolute number or you use per value. Whichever one you use, you are going to get the same answer. So I believe this is clear. Okay, so it's the same thing that we have here, the same 7%. Let me know if you have any question before we move to cost of debt. Any question for me so far? Okay. So if there are no questions, we'll move to the next one. So let's talk about cost of debt. Okay. Now, when it comes to cost of debt, the cost of debt represents the compensation required by the providers of debt capital from their investment in the company. The debt holders, generally the debt holders are entitled to receive from the company the annual fixed interest. The debt holders are entitled to receive annual fixed interest from the company based on their investments. In the event of liquidation, the debt holders will be settled before any other investor, before any other creditors. Once a company liquidates, the debt holders will be settled first. After the debt holders, then you settle the preference shareholder. If there's any residue from the disposal, then of course that residue belongs to the owners of the business. However, generally, we say that debt is a cheaper source of financing because of tax deductibility benefits. When it comes to financing with debt, there is tax relief that is usually attached. So instead of the company, say for example, instead of the company to pay 10% interest, so if there is tax, the company may pay lower. It could be 8%, it could be 7%, it could be 5% as a result of tax. And that's why it is being said that debt is a cheaper source of financing because of tax deductibility benefits. Again, just as you have under preference share, we have callable, non-callable debts. We have redeemable, irredeemable debt. The callable debt is the same thing as redeemable debt. What do you mean by redeemable and irredeemable debt? Let's take it one after the other. Let's start from irredeemable debt first. As far as irredeemable debt is concerned, the company will only pay to the debt holders. The company will only pay to the debt holders annual fixed interest, but the principal will not be repaid. I repeat, for irredeemable debts, the company is expected to pay to the debt holders only the annual fixed interest, but the principal will never be repaid. However, for redeemable debt, the company is required to pay to the debt holders annual fixed interest and the principal at the maturity date. Say, for example, the maturity the maturity date for this debt is about 5 years, in 5 years time. So every year the company will be paying annual fixed interest. At the final year, which is the 5th year, the company will also pay annual fixed interest and the principal sum. This is what is called redeemable debt. Also, redeemable debts can be redeemed at par, at premium, or at a discount. I repeat, debts can be redeemed at par, at a discount, or at a premium. One more thing you need to understand as far as redeemable debt is concerned is that debt is usually quoted at 100 naira per unit. As far as redeemable debt is concerned, it is usually quoted at 100 naira per unit. You have to note that. Okay, you have to know that. Now, there are principles you also need to consider. All those things that we did under cost of equity, where you have cum div, ex div, and all of that. The same thing under debt. You can have cum int and ex int. So if it is cum int, then you need to convert it to ex int before you can calculate the cost of debt. So in this case, when you want to convert cum int to ex int, of course, you make ex int the subject of the formula. You make ex int, that is excluding interest, the price that excludes interest. So ex int price, it will be calculated as cum int price minus the interest expense minus the interest. So that will give you the ex int price. So you have to shine your eyes when you get to the question. Once the market price of the debt, either bond or loan note or debenture, once you discover from the question that the interest has not been paid, it means that the market price of that debt is called, it is cum int. So you need to convert it to ex int price. So this is how to convert it to ex int price. Okay, to convert cum int price to ex int price. So that's the formula you need to use. Remember what I said, at all time, debt is always quoted at 100 naira per unit, except examiner says otherwise. At times, examiner can tell you that it is 1,000 naira per unit. But in most cases, it is usually quoted at 100 naira per unit. So these are the things you need to know as far as the cost of debt is concerned. Therefore, how do you then calculate cost of debt? How do you calculate cost of debt? Cost of debt is calculated as the ratio of fixed interest to ex int price. I repeat, cost of debt is calculated as the ratio of fixed interest to ex int price, depending on whether there is tax or no tax. So where there is no tax, the cost of irredeemable debt is the ratio of fixed interest to ex int price. But where there is tax, you need to incorporate the tax elements. Okay, where there is tax, it is fixed interest multiplied by 1 minus tax rate, then divided by the ex int price. So where you have tax, this is the formula you are supposed to use. Sorry, where there is no tax, this is the formula you are supposed to use. But where there is tax, this is the formula to use. All of this, you must consider them. Okay, you must consider them. This is what I was trying to tell you the other time, that under this note, where the interest expense has not been paid, it means the market price of the debt is cum int. Therefore, the current price should be converted to X int price before calculating cost of debt. So that's what we did here. That's what you did there. So you have to take that into consideration. So at this point, let's have a short examples. Let's have a short examples. Okay, let's have a short example. Now, I need somebody to read for us so that it won't be like I'm the only one talking. Yes, who is helping us? Who is helping us?
I'll read.
Okay, thank you, Timilayi.
Aberdeen PLC is financed with 10 million naira 9% redeemable debenture quoted at 102 naira. Interest on debenture was paid last week. What is the cost of debenture if 1, the company is not liable to pay tax, and 2, company tax rate is 40%?
Thank you very much, Timilayi. Now, you can see in this question, examiner was specific by telling you that the company is financed with 10 million naira 9% redeemable debenture. This is redeemable debenture quoted at 102 naira. Interest on debenture was paid last week. So which means that this 102 is already X int price because interest has been paid. However, because the examiner has mentioned that redeemable debenture, an average student can get confused because the examiner has mentioned redeemable debenture, and then you start looking, when you don't have the information you are looking for, the additional information you are looking for, you get confused. The only reason that, like I mentioned to you earlier today, the only reason that we make this redeemable debenture to be redeemable, or that we make this debenture to be redeemable, is if you are given the redemption date. That is, when the company will pay back the debt. So in this question, the redemption date is not given to you. So where redemption date is not given, it will be treated as cost of irredeemable debenture. I hope that is clear. So in this case, we are going to calculate cost of irredeemable debenture. An examiner has told us that where there is no tax and then where there is tax of 40%. And you know that cost of irredeemable debt is calculated that where there is no tax, it's calculated as fixed interest, okay? Fixed interest divided by X int price, multiplied by 100/1. Therefore, I will go to the question. What is my fixed interest? Interest is 9%. Interest is the coupon rate attached to the value of the debt, okay? This 9% is the coupon rate. That's the interest rate. So it is attached to the value of the debt of 10 million naira. So which means that the debt holders, the debenture holders will receive 9% of 10 million naira annually as interest. So I don't need to waste my time and be using absolute number. I will just use power value. In this case, I will just say KD equal to 9% is the same thing as 9. It's 9 naira. Forget about the percentage because debt is always quoted at 100 naira per unit. So forget about the percentage behind, just put 9 there. Then the denominator is X in price. The X in price is 102 naira. So here I will say 102. Then multiply by 100/1, which will give me the same thing as 9%. That's what I need to do where there is no tax. But where there is tax, I need to incorporate tax. So when you look at the solution, look at what I said there. Okay, look at what I said there. For a debt to be redeemable, the redemption date must be given. If the redemption date is not provided, it will be treated as cost of irredeemable debt. In the case of Aberdeen PSC, the debenture is shown as redeemable, but the redemption date is not provided. Therefore, the question will be solved as cost of irredeemable debenture. You see that? So that's what you need. You must know what to do at the right time. The direction of the question will tell you what to do. So that's that. Okay. All right then. So in this case, what am I supposed to do? I've gotten my answer to be 9%. Okay, that's the answer, to be 9%. Okay. So the second one, where there is tax. Where there is tax, my formula will change. Where there is tax, my formula will change. I need to incorporate tax. Therefore, I can then say KD, cost of irredeemable debt, is calculated as fixed interest, okay, multiplied by 1 minus tax rate, then divide by X int price, or multiply by 100 over 1. So that's what we have done here. That's what we have done here. 9 multiplied by 1 minus tax rate of 40%, divided by 102 X int price. At the end of the day, we got 5%. Look at what I was telling you when I was trying to define cost of debt with you. See, we said that generally, debt is a cheaper source of financing because of tax deductibility benefits. You can see where there is no tax, Aberdeen PSC will pay 9% as cost of debt, cost of financing. The cost of financing Aberdeen PSC will pay to the debt holder or to the debenture holder is 9%. But because of tax of 40%, the cost of the debt has reduced to 5%. So that's why it is said that debt is a cheaper source of financing because of tax deductibility benefit. I believe this is clear. Okay, then. So,
Very clear.
all right, thank you. So let's talk about redeemable. Let's talk about redeemable debts. After that, then we talk about types of debts, and that's where we are going to stop today. But first thing first, let's talk about redeemable debt. I've already explained what redeemable debt is all about when I mentioned that redeemable debt is the one in which the company will pay annual fixed interest and the principal at the maturity date. And I also mentioned that the debt could be redeemed at par, at premium, or at a discount. So how do you then calculate cost of redeemable debt? So the cost of redeemable debts will be calculated the same way we calculated cost of redeemable preference share. Simply go ahead and calculate internal rate of return. When you want to calculate cost of redeemable debt, go ahead and calculate internal rate of return, because that same cost of redeemable debt is called yield to maturity or internal rate of return. When you get to bond valuation and analysis, which Mr. Asiwaju will take you, you are going to learn about how to determine the value of bond and also the bond yield, okay, the bond yield. So all of these things, we are going to discuss it again when you get there, all right? So in that case, how do you then calculate cost of redeemable debt? Like I said, just go ahead and calculate internal rate of return, which is the same thing as yield to maturity. The first step is to assume two discount rates that will produce two opposing NPV. Then the second step is for you to calculate your cost of redeemable debt using internal rate of return formula. That's all. It's as simple as that. No matter how big is the question, you don't go beyond those two procedures. Assume two discount rates that will produce two opposing NPV, one positive NPV and one negative NPV. Then you proceed to calculate the internal rate of return. Whatever you have is your cost of redeemable debt. It's as easy, simple, direct as that. So if that is the case, let's have a short example to demonstrate that. The value of debt I'm talking about when we get to, maybe when we get to cost of convertible security, or until we get to weighted average cost of capital, I will explain to you what is market value of debt, what is market value of equity, what is market value of a preference share. I will also show you the formulas that you can use to do that, different kinds of formula that you can use depending on the information given in the question, okay? So, all right, so let's have a short illustration to this. Let me use the question that I've shared with you. I was talking on the same page. Don't want somebody to be asking me, where did you see the question we solved in the class? Okay, we are done with this. We are done with Aberdeen. We're done with Jonathan. No. Okay, let's solve illustration number 6. Let's solve illustration number 6. Oh, sorry, let me. Which one am I even presenting? Illustration number 6. Okay, somebody should read for us. Emery PLC. Who will read? Emery.
I'll read it again.
Thank you, Timmy. Go ahead.
Emery PLC has 10% redeemable debenture in its capital structure. The debenture is currently quoted at 106 Naira ex int, and it will be redeemed at par in 5 years' time. Required, calculate the cost of the company's debenture.
Thank you very much. That is the question. Examiner wants you to calculate cost of debenture. So I need to ask myself, what kind of debenture? This is redeemable debenture because examiner has told you that the debenture will be redeemed in 5 years' time. Okay, the debenture will be redeemed in 5 years' time. So as a result, I need to go ahead and calculate the internal rate of return. Let me look for space here. If I have any other than that, I can use my working notes to do that. Let me see if I can get a bigger space. It's dragging too long. No, I don't want to go too far. Let me look for a space that I can use. I will manage. Okay. This is what we do. I will then come here. I want to calculate cost of redeemable. Let me use this space. Let's see if this space will occupy. I don't want to go to the working notes. Or should I use the working notes? Yeah, let's use the working notes just so that we will not be restricted with space. Let's use the working notes. Okay. Yes, the name of this company is Emery PLC. So I would then say calculating costs of redeemable debts, redeemable debenture. Okay. Now, like I said, whenever you want to calculate cost of redeemable debenture, the first thing you need to do, you need to go to the question and check if you are given the redemption date. If the redemption date is given, then you can then confirm it is redeemable debt. But if the redemption date is not given to you, you are going to treat it as cost of irredeemable debt. But in this question, we are told that the debenture will be redeemed in 5 years' time. So confirm it is redeemable. So the next thing I need to do now is to assume 2 discount rates that will produce 2 opposing NPV. So when you want to assume your discount rates, always start from 10%. When you want to assume your discount rates, always start from 10%. Why did I say so? Because if you assume 10% and 10% is positive, you can easily increase to 15%. But if you start from 5% and 5% is positive, you increase to 10%, 10% is positive, then you just be doing iteration and you don't have that luxury of time on the day of your exam. So if you start from 10%, then you can easily increase. If 10% is positive, is negative, then you can reduce to 5%. So whichever way. So always start from 10%. So at this point, I would need to create columns. Okay. Column for year, description of item, cash flow, discount factor, then I also have present value. Okay. So we are using par value. So I have year 0. We are told that this, please, since you have the question, so we are told in the question that the debenture will be redeemed in 5 years' time. Okay, so which means that every year the company will be paying annual fixed interest, year 1 to 5. Then at the final year, the debenture will be redeemed. So here is current value, current market value. Okay, let me write that. Then annual fixed interest. Then at the 5th year, at the final year, this debenture will be redeemed. So I will calculate redemption value. Okay, then. So I will go back to the question. My cash flow, the current market value. Go back to the question. What's the market value of the debenture? We are told that the debenture is currently quoted at 106 naira x interest. So 106 naira is the x interest. So here I will say 106. So we are using par value. That's 106. Put it in brackets. Okay. But if the interest expense has not been paid, I cannot use 106. I need to first of all go and deduct the interest, the coupon. I will deduct the coupon. The coupon in this question is 10%. Okay, the coupon rate is 10%. So 10 minus 106, that's 96. So if interest expense has not been paid, I will just put 96 instead of 106. But because interest has been paid, that's what I'm using 106. Then the interest the company will pay will depend on whether there is tax or there is no tax. In this question, the examiner did not give us tax rates. So that means tax will not impact it. So I'll just put 10. Remember, don't come in and be putting 0.1. Just put 10 because debt is always quoted as 100 naira per unit. So 10% of 100 naira will still give you 10 naira. So just put 10 there. Then redemption value. How you then go back to the question, how is the debenture going to be redeemed? Is it at par, at premium, or at a discount? According to the question, you are told that it will be redeemed at par in 5 years' time. At par means at 100 naira. Remember, debt is always quoted at 100 naira per unit. So at this point, I need to discount to get the present value. So we're assuming 10% first. Then we also assume 5%. Okay, let me draw my table. All right. Okay. 10%. Let me draw that again. Okay. This is our NPV, then 5%. All right, then. So discount factor at year 0 is 1. Here is also 1. 1 multiplied by 106, 106, 106. Okay. Then I need to calculate annuity factor of year 1 to 5 at 10%. What do you get? That's 3.791. Am I correct? Am I correct? Are you still there? Anyway, yes. Annuity factor 5%. Annuity factor 5%. Why am I even using 5% since I don't know what 10% will give me first? But in any case, so let's multiply. Let's multiply 10 multiplied by 3.791 equal. That's 37.91, 38, rounding 38. Here is 38. Then this one will be 62. Therefore, 62 plus 38, that's 100. 100 minus 106, that's 6, negative 6. So we assume 10% and we got a negative NPV of 6 naira. So let us assume a lower discount rate. Let's assume 5%. Okay. So annuity factor at 5%, year 1 to 5 should give us 4.329. We've got it. We've solved that earlier today. Then discount factor at year 5, 5% should give us 0.784. Therefore, what do you get here? What do you have? 10 multiplied by 4.329 equal, that's 43 rounding. Here is 43. Then here will be equal to 78.784 multiplied by 100 will give us 78. So 78 plus 43. 78 plus 43 equal minus 106 equal, that's 15 positive. So at this point, I need to calculate my internal rate of return, which is cost of redeemable debenture. So I would then say KD, which is the same thing as internal rate of return, is equal to lower discount rate plus NPV of the lower over NPV of the lower plus NPV of the higher, all multiplied by higher minus lower discount rates equal. We assume 5 and 10%. 5% is lower. So 5 plus NPV of that 5 is 15 divided by 15 plus NPV of higher 6 multiplied by higher of 10 minus lower of 5. Final answer 15 divided by 21 equal multiplied by 5 equal plus 5 equal 8.6%. So here is 8.6%. Approximately the cost of redeemable debenture is 9%. So that is that. That is that. Okay. So let me know if you have any question for me so far. Any question for me so far? Do you have any question for me? Okay. That's that. So that's the question. Again, immediately after the class, I will share the recording with you, but that's not the end of the class. We still have to talk about the types of debts. It's important that we talk about the types of debts. I think the class I will end the class by 2:30 maximum. No, sorry, 1:30. 1:30, we still have time. So that you can, for those of you that will be having audit is 3 to 5. Okay. In any case, let's move on. Let's maximize the time that we have. Now, when you look at this, okay, let me stop sharing this. Yeah. When you look at this illustration number 7, examiner is asking you to calculate the value of the debenture. Maybe at this point, let me just demonstrate. Let's explain what value of debt is all about. Whenever you are asked to calculate market value of equity, market value of preference share, market value of debt, it's not something that is strange. It's something you're already familiar with. But at times, students may get it confused if you don't know the underlying concept. When you're asked to calculate market value of equity, you must first of all know what is market value of equity, right? Market value of equity simply means the present value of future cash flows discounted at the cost of equity or rate of return on equity. I repeat, the market value of equity is the present value of future cash flows discounted at the cost of equity or rate of return on equity. What is the future cash flow as far as equity is concerned? There are two future cash flow. In fact, there are major one future cash flow, which is dividend payments. So whenever you are asked to calculate the market value of equity, is just the present value of future dividend payment discounted at the cost of equity or rate of return on equity. Let me scroll down and find a bigger space where I can demonstrate the formula for all the market value at once. Okay, let's use this space. Now, when you want to calculate market value of equity, I don't know if I demonstrated for you last time in the class. In this case, we are talking about the total market value, for example. So like I said, market value of equity represents the present value of future cash flow, that is future dividend payment, discounted at the cost of equity. So if I want to calculate market value of equity, there are two ways depending on the information given to me. If in the question, examiner did not give to me number of shares, therefore, my market value of equity could be calculated as share capital divided by nominal price or nominal value or nominal price multiplied by XDIV share price. Okay, multiplied by XDIV share price. So this is the formula for calculating market value of equity. But if in the question I'm given, number of shares, then market value of equity could be calculated as number of shares multiplied by XDIV share price. Okay, multiplied by XDIV share price. So that is what you need to, let me rewrite that so that, okay, number of shares multiplied by XDIV share price. So you only use share capital over nominal price if in the question you are not given number of shares. Once you are given number of shares, just multiply the XDIV share price on the number of shares. You get the market value of equity. So let's talk about market value of preference share. What do you mean by market value of preference share? The market value of preference share represents the present value of future dividend payment discounted at the cost of preference share. Okay, discounted at the cost of preference share. I repeat, the market value of preference share is the present value of future dividend payments discounted at the cost of preference share or rate of return on the preference share. So in this case, the same formula. If you are not given number of shares, then I will say share capital divided by nominal price multiplied by XDIV share price. It must be XDIV share price of the preference share, okay? Or if the number of shares is given, then it is number of shares multiplied by XDIV share price. You can see it's nothing different from the market value of equity. The only thing is that the share price you are using is for the preference share. The other one is for the equity. So finally, let's talk about market value of debts. The market value of debt. The market value of debt represents the present value of future cash flow discounted at the cost of debt or yield to maturity or yield on the debt. Let me repeat. The market value of debt represents the present value of future cash flows discounted at the yield or the cost of debt. When you talk about present value of, when you talk about future cash flow under debt, the future cash flow is the interest expense, discounted at the yield of the debt. All right. So if it's a redeemable, then the market value of redeemable debts represent the present value of the future cash flow discounted at the yield of the debt. The future cash flow include both the interest expense and the redemption value. Okay, please note all of this. So when I now want to calculate the market value of the debt, I will just say nominal value. Okay, nominal value. The nominal value is the balance sheet amount. The amount you have in the balance sheet is the nominal value. Then multiply by X int price. X interest price. Divide by 100. Remember, debt is always quoted at 100 naira per unit. So this is the formula that you are going to use to calculate the market value of debt. Market value of preference share, the market value of equity. So you must master them depending on the information you have in the question. So you must know the formula to use at the right time. So that's that. At this point, let's solve one illustration that has to do with market value. Let's see if we have illustration on market value.
Hello.
Yeah. Yes, Samuel, talk to me. Talk to me, Sam. Are you still there?
Okay.
Yeah. It's not clear.
When you started market value of equity.
Take
When
it again. The line is breaking. I couldn't hear that.
Market value of
No. The network is bad. I can't hear you. The network is bad. I can't hear you. Maybe you send me the chat.
Yes. Can you hear me, sir?
Your line is breaking. So send me the
Hello,
chat.
sir. Can you hear me now, sir?
It's better now.
Okay, but question. I'll type the question, sir.
I can hear you now. There's no need to type again since I can hear you now better. Yeah, talk to me. Talk to me, sir.
Okay, sir. So, while you mentioned market value of equity the other time,
yeah,
you also talked about future cash flow can come in two ways.
yes.
I think you mentioned dividend payment, but I'm not sure you mentioned the other one.
No, what I'm trying to say is that I said
sir.
the market value of equity represents the present value of future cash flows discounted at the cost of equity or rate of return on equity. So the future cash flow in relation to equity is the dividend payments. So it's the dividend that the company is expected to pay in the future to the shareholders. So that's the future cash flow. But for the preference share, the future cash flow, the future cash flow of preference share will come in two, depending on whether it is redeemable or irredeemable. If it is redeemable, then the present value of future cash flow, if it is irredeemable, then it will be only fixed dividend. But if it is redeemable, so it will be fixed dividend plus the present value of the redemption value. Okay?
All right, sir. All right, sir.
All right then.
Thank you, sir. Yes.
You're welcome. Then let's have illustration that talked about calculating market value for debt. Let me see from this question. Okay, so let's solve this illustration number 7. In this illustration number 7, you have to calculate the unit value of the debenture. Somebody should read for us, please. Yes, who's reading? Who's reading for us?
Okay, so I'll read.
Okay.
So, okay. Azad PLC.
Right.
Can you hear me?
Yes, I can hear you.
Okay.
Or
Hazard
you
PLC is
know,
financed
Hold
by
on, hold on,
8%.
hold on, Ghania. Sam, what are you trying to say? Your line has gone bad again.
No, I was saying that I'm not sure if I'm audible enough so
You
that
are
I
not
can
audible.
take the question. But since she's
Oh, okay. You are
taking
not
it, it's fine.
certainly you are not audible. Your line is is doing well. No worry. Okay, then Ghania, go ahead.
Hazard PLC is financed with 8% redeemable debenture with total nominal value of 10 million. This debenture will be redeemed in 10 years' time at a premium of 5%. The current yield of the debenture is 7%. Calculate the unit value of the venture.
Thank you very much, Ghania. Now, this is the question. Please, whenever you are given a question, you must be very careful. No matter how small it is the question, there is something that the examiner wants to test. So in this particular one, examiner wants you to calculate unit value of the debenture. You want to calculate the value per unit of the debenture. So how do you do it? The first thing that should come to your mind, once you see that you have to calculate value, you can see you have to calculate value. The first thing that should come to your mind is the definition. This is talking about debt, debenture. Therefore, the market value of debenture or debt is the present value of future cash flow discounted at the yield of the debt. In this case, I will go to the question. I need to check, is it a redeemable debenture or irredeemable debenture? According to the question, examiner has told us that this debenture will be redeemed in 10 years' time. So what this simply means is that the future cash flow, the expected future cash flow would be fixed interest as well as the redemption value. I repeat, under debt, the market value of debt, I've said it earlier today, if it is redeemable, then the market value of debt is the present value of future cash flow. What are the future cash flow? The fixed interest and the redemption value discounted at the yield of the debt or cost of the debt. So once I've gotten, what this is simply saying is that I need to calculate the present value of the fixed interest. Present value of the fixed interest, I will keep it on one side. I also need to calculate the present value of the redemption value. I will add the two together. This will give me the market value, which is the same thing as present value. That's why we are saying that the market value of debt represents the present value of the future cash flows discounted at the yield of the debt. In this case, the future cash flow will include the interest expense and then the redemption value. So all I need to do is to go ahead and calculate the present value of the fixed interest, the present value of the redemption value. I will add the two of them together. That will give me the market value or the present value. So when you are calculating market value, you don't consider year zero. If you consider year zero, what you are simply doing is calculating NPV. I believe that is clear. When you want to calculate market value of debt, you don't consider year zero. If you consider year zero, that means you are calculating NPV, not present value. So, and that's why we said that, that's what I told you, that the market value of debts is the present value of future cash flow. So the future cash flow is the fixed interest and the redemption value discounted at the yield of the debt. So in solving this question, I don't need to waste my time. I will just come down here. Let me look for a space. Okay. Solution to illustration number 7. Solution to 7. The name of the company is, what's that? Hazard. Okay, the name of this company is Hazard PLC. Hazard PLC. What are we asked to do? Calculating unit value of the debenture. Okay, I want to calculate the unit value of the debenture. So it's the same way you calculate your NPV, only that you don't include year zero. Okay, so I'll create a column for year, create a column for description of item, create a column for cash flow, create a column for discount factor at what's the yield? We are told that the yield is 7%. Then I'll create a column for present value. That's all. Okay, so we don't include year zero. I will then go to the question: what's the maturity date? What's the redemption date of this debenture? We are told that the debenture will be redeemed in 10 years' time. The debenture will be redeemed in 10 years' time. Therefore, from year 1, year 2, year 3, up to year 10, the company will pay annual fixed interest. So I will then come here, year 1 to 10, fixed interest. Okay, the interest of how much? What's the percentage? What's the coupon rate of the debenture? The coupon rate of the debenture is 8%. Okay, we are told that Aza PLC is financed with 8% redeemable debenture. So the coupon rate or the interest rate is 8%. Okay, 8%. So I will then come here. Here I will put 8. There is no, forget about the percentage. I've told you earlier. Then in year 10, at the final year, this debenture will be redeemed. Redemption value. So I will go back to the question, how am I going to redeem the debenture? Examiner has told you in the question that the debenture will be redeemed at a premium of 5%. Okay, we are told that the debenture will be redeemed at a premium of 5%. You know, par value is 100 naira. So if the debenture will be redeemed at par, that's 100 naira. At par means equal to 100 naira. At a discount means less than 100 naira. Less than 100. At a premium means above 100. Above 100. Okay, so that's that. So in this question, you have been given a premium of 5%. So 5% plus 100%, that's 105. So you have a premium of 105. So in this case, the redemption value is 105. So I need to calculate annuity factor of year 1 to 10 at 7%. So I would then say 1.07 raised to power 10 minus equal minus 1 equal divided by 0.1, sorry, 0.7 divided by 0.07 equal, then minus 1. What am I doing? Okay, no. Oh, sorry, that's a mistake. 1.07 raised to power 10 minus equal, then minus 1 equal divided by 0.07 equal. That's 7.024. Here is 7.024. Okay. Then final year 10 discount factor 1.07 raised to power 10 minus equal 0.508. Here is 0.508. Let me rewrite this one to make it clearer. Okay, then, so let's get the present value. So I will add these two together to get the present value. This is what is called market value. That's what I say. It is present value of future cash flow discounted at the yield of the debt. Okay, then bring out your calculator. 8 multiplied by 7.024 equal, that's 56, rounding 56. Here is 56 naira. Then 105 multiplied by 0.508 equal, that's 53. Here is 53. When you add the two together, that's 109. 109. That's 109. Okay, that's that. That's that. So the market value is 109. Okay. So this is what examiner wants you to do. And that's what we have done. Let me even check the, yeah, premium of 5%. Yeah, that's it. So that's that. I believe it's clear now. Like I said, when you get to bond valuation and analysis, you are still going to do the same thing. When you get there, Mr. Asiwaju will tell you, yeah, okay. So, okay. Let me, Ronaldoli. There's one particular short example, so I want to demonstrate for you, which is Ronaldoli. In any case, yes, that's that. What else? Okay, let's talk about.
Sorry, sir. I want to
Yes.
clarify something. So to calculate the cost of company debenture is quite different from cost of unit value of the venture.
Yes, this one is in Naira. When you are calculating value must be in Naira. When you are calculating cost, it must be in percentage.
Okay.
Yeah.
Okay. Thank you.
You're welcome. So if that is the case, let's talk about types of debts. Or before we talk about types of, we still have about still have more time. So let's have one more illustration. Because when you get to bond valuation, I don't want to, at least you should have idea when Mr. Asiwaju is talking to you, even though this one does not relate to bond valuation, but there are some information here that will come in handy when you get there. Okay, then let me see if I can have additional illustration, not in this material. Let me stop sharing this. Let me stop sharing this. Go to the other one. I want to see if I can, okay. There's a particular question. Let me share my screen with you. I want us to go through together. That's not here. Not this one. Okay. I'm trying to share. So let's look at this example number 2 together. Let's look at this question together. Somebody should read, please. Yes. Who is reading? Who will help us to read?
Ronaldoli PLC.
Thank you.
An 8% redeemable debenture, currently quoted at 103 Naira as at today, 28 December 2018. The debenture will be redeemed at par on 1st January 2022. The company has a policy of paying debenture interest every 31st December. What is the company's cost of debenture if the company is not liable to pay tax? 2. If the company tax rate is 40%.
Thank you very much. I An average student may struggle to answer this question correctly if particular attention is not paid to the dictate of the question. In the requirements, you are to calculate the cost of the debenture if the company is not liable to pay tax, and 2, if the company tax rate is 40%. So examiner has called it redeemable debenture. The redemption date as given to, we are told that the company has a policy of paying debenture interest every 31st December. However, you are now told that today is 20th December 2018. The debenture will be redeemed at par on 1st January 2022. So you need to determine the redemption date. When is this debenture going to be redeemed? If today is 28th December 2018, 2018 is not part of it, because for you to be able to count 1 year, you must be able to count 12 months, January to December. So if today is 28th December, then that means 2018 is already gone. It's not part of it. So you pick 2019. You have 2019, 12 months. Okay. You have 2020, 12 months. You have 2021, another 12 months. In 2022, we are told that it will be redeemed on 1st January 2022. January 2022 is not up to 12 months. That means this debenture will be redeemed in 3 years' time. So the maturity date of this debenture is 3 years' time. Okay? Now that we have established it is 3 years, this debenture has a maturity date of 3 years. So if that is the case, I need to go ahead, do the normal thing that you do to calculate your cost of redeemable debenture. Just go ahead and calculate the internal rate of return. You go ahead and calculate the internal rate of return. So now I need to check from this question whether debenture interest has been paid or not. You will notice in the question the examiner did not see. Look at, you are told that today is 28th December 2018. All right. And the company usually pay debenture on the 31st of December. On the 31st of every December. So that is not yet 31st. That means the debenture interest has not been paid. So what I need to do now is to go and make adjustments. Before I calculate my net present value, I need to adjust for the current current market price of the debenture. 103 Naira is the current price of the debenture. Debenture interest has not been paid. So I need to less the coupon payment. The coupon is 8%. So 8 minus 103 will give me 95. Therefore, the current market value will be equal to 103 minus 8, which is equal to 95 Naira. So it is this 95 Naira I'm going to use for year 0. Again, for the fixed interest, I need to calculate the present value of the fixed interest. So examiner has told me that there is no tax. So if there is no tax, then 8 Naira will be the year 1 up to year 3. 8 Naira for my fixed interest. I will calculate annuity factor of year 1 to 3 at whatever percentage, at whatever discount rate that I've assumed. Then final year, I will redeem at par. At par means at 100 Naira. So that's this is what I need to do. Where the second one, where there is tax, what am I supposed to do? Very simple. I need to go and calculate post-tax interest first. In the second one that has tax rate of 40%, I need to calculate post-tax interest or after-tax interest. So the after-tax interest is calculated as interest multiplied by 1 minus tax. So the interest is 8%, which is 8 into tax rate is 40%. Then that means we have to account for 60%. So this should give me 4.8 or thereabouts. Okay, so instead of me to use 8, I will use 4.8. So I already have the solution here. Let's just go through it together. Now, this is what I'm trying to say. So assuming 10%, you can see here that the current market value is 95. Examiner has given to us 103, but the debenture interest has not been paid. We need to first of all less. So this 95 is X int price. The 103 given in the question is cum int price. So you don't use PUMIT price, it has to be X-int price. So that's what I went ahead to first of all deduct the interest expense from the current market value from the PUMIT price before you can get the X-int price. Again, because there is no tax, the coupon payment is 8 Naira and the debenture will be redeemed at par. At par means 100 Naira. So discount factor, annuity factor of year 1 to 3 at 10% is 2.487. Annuity factor discount factor at 10%, year 3 is 0.751. So when you multiply 95 by 1, you got 95. 2.487 multiplied by 8, we got 20, rounding. Then 0.751 multiplied by 100 will give me 75, rounding. So 20 plus 75, that will give me 95. So 95 minus 95 will give me 0. Because my NPV is equal to 0, it means that the cost of redeemable debenture is 10%. Why is it 10%? Because internal rate of return is the rate that equates NPV to 0. Any rate that you use to calculate internal rate of return and give you 0 NPV, that rate is the internal rate of return. So since we assume 10% and 10% produce a 0 NPV, it means that the cost of redeemable debenture is 10%. I believe that is clear. So look at the further additional information I put here. Note, where the assumed discount rate for calculating NPV produce a 0 NPV. Such discount rate is the cost of redeemable debenture, that is internal rate of return, since IRR is the rate that equates NPV to 0. That's it. That's no need to calculate internal rate of return again, since you already have 0. That 0, the discount rate that you use that produce that 0 is your cost of redeemable debenture. That's one. Then number 2, examiner says where there is tax rate of 40%, where the company is liable to 40% tax rates. So in this case, I need to go and calculate post-tax interest. I need to calculate post-tax interest. So in this case, I think I did the working here somewhere. Yeah, that's the working there, 4.8. 4.8 is the post-tax or after-tax interest, okay? So if that is the case, I will then come there. I will assume 10%. Instead of using 2 tables, you can use 1 table. Do it the same way that I did the other times previously. So merge them in the same tables. That will save your time instead of having 2 different tables. In order to oversimplify it, that's what I put it here in different table. So in this case, 95 is the X-int price. Okay, multiplied by 1 will give me 91. So will give me 95. The after-tax, the post-tax interest is 4.8. 103 minus 8. That's 0.6 multiplied by 8. That will give us 4.8. So discount factor at 5, annuity factor at 5%, year 1 to 3 will give us 2.723 multiplied by 4.8. That's 13. Okay. Then discount factor for year 3 at 5%, that's 0.864 multiplied by 100. That will give us 86. So 86 plus 13, okay, that's 99. 99 minus 95, that will give us 4. Okay, or if you want to put decimal points, still the same thing. Then at 10%, the annuity factor of year 1 to 3 at 10% is 2.487. Discount factor at year 3, 10%, 4.751. So 2.487 multiplied by 4.8 will give us 12. 0.751 multiplied by 100 will give us 75. 12 plus 75, that will give us 80. That will give us 87. So 87 minus 95 will give us 8. Okay, will give us 8. That's how you have that negative 8. All right, so you just interpolate in the IRR formula, and we got 7%. That's it. This is what you need to do in that question. But the only technicality area is that if you don't know how to, here how to know that what is the maturity date or redemption date of the debenture. So a student may get it wrong, and that's why I have to take my time to explain that. Okay, so that is the question. That is the question. So take care of this, all these little things. These are the principle you must understand first before you go to a bigger, before you go to a bigger battle. When you are going for a match, you have to rehearse. All what we are doing now is rehearse. We are just doing rehearsal. All right. We are practicing it. We are doing practicing. We are testing the principle so that by the time you get a bigger likely question you are going to see on the day of your exam, you are not going to struggle. All right. So you can't just you must test the water first. You put your leg in the small water to know whether it is deep or not before you jump into the water. So you can't just go straight to a big question without understanding the concept. That is what we are doing. Okay, then. So finally today, let's talk about types of debts. Let's talk about types of debts. And before that, let me see. Some of you have disappeared. No worries. Okay, then. So let's talk about types of debts. And that's where we are going to stop. Types of debts. There are basically two types of debts. One, we have traded debts. Traded debts. Then two, we have non-traded debts. These are the types of debt that all of you are familiar with. Okay? What do you mean by traded debts? Traded debts are fixed income security that is tradable or that can be bought or sold in an organized financial market. I repeat, traded debts are fixed income security that can be tradable or that can be bought or sold in an organized financial market. Examples of traded debts include bond, debenture, or loan notes. Loan notes. So these are the examples of traded debts. You can buy and sell bond, debenture, loan notes in the financial market. And they are fixed income security. Fixed income in the sense that the three of them, the investor will receive fixed interest. The investor will receive fixed interest. That's why it is called fixed income security. Okay, include the preference dividend is also fixed income security. But we are talking about debt. All right. So traded debt are fixed income security that can be bought or sold in an organized financial market. Examples include bonds, debenture, and loan notes. The second one, non-traded debt. These are securities that cannot be bought or sold in an organized financial market. They are securities that is not tradable. There are securities that are not tradable. Examples include overdraft and bank loan. Okay, examples include overdrafts. Okay, overdrafts and then bank loan. You can't take your bank loan to the market to say you want to buy or you want to sell. It's not possible. Okay, so these are the examples of non-traded debts. And this is where we are going to call it a day. So let me hear from you, please, if you have any question for me. Any question? Any question? Is it that nobody online or you guys are just there?
Well, here, sir. No, from my end, no
Okay.
question.
Okay.
Everything.
Amarachi, are you online or you just on your PC or your phone to know that you are there? Let me hear from you, Amara. Amarachi, Ama, you are there. Olatunde, are you online? Olatunde, let me hear your voice. Tunde is not there. Bello, Abdulkadir, are you online? Abdulkadir,
Yes, online. Yes.
okay.
Yes.
Christiana, are you on?
Yes, I'm alive. I don't have any
Okay.
questions now. I have
Okay. Any baby, are you online? We are marking register.
Yeah, I'm here, sir.
Okay. Yes, Frank. Yeah, Frank read the other time, but I'm not sure if he's still on. Frank?
I'm online, sir. I'm online, sir.
Okay. Then who's next? Gabriel. Gabriel Unang, are you on? Oh, you have disappeared. Okay. Okay. I think Ganiya is still around, but let me hear from you. Ganiya, are you there?
Yes, sir.
Okay. Gloria, what happened? You did not talk to me today. What happened?
Good morning, sir. I'm online.
It's okay. Yes, Afsa.
Is that the recording that I
Afsa, are you around? Hello? Afsa. I'm not sure Afsa is around though. She has disappeared. Ibrahim Wazo. Hello, Ibrahim. Are you there? Who is iPhone? who is iPhone? Yes. Okay. Naomi, talk to me. Oh. Okay. Oh. Noye, yeah, now talk to me so that we can close the class. I want to hear from you guys. So I've got about five people now that are absent. Okay. Oh. I know what to do.
I'm good. I don't have any questions.
I'm not okay. I'm marking register. That's why I need you to talk to me. Yes, Noye, you have not talked. Then Olamide.
So I'm the one that just spoke now.
Oh, okay. No, yes. Olamide. Olamide, are you there?
Yes, I am, sir.
Okay. Ibukun, IBK.
Yes, I
IBK.
am. I am.
Okay. Okay. Then I have Sumto.
Yes, I am.
Good. Sunday Nko.
I am here, sir.
That's good. So I'm not sure if Naomi did not talk. I think Naomi talked. Then this person that is using iPhone, I don't know the person. The person did not talk. Afsat did not even talk too. About 2-3 of you refused to talk to me. No worries. Okay, guys.
I'm
Thank
here.
you.
Can you hear me?
Okay. I'm sorry, Zarant. Okay. Thank God. Because I have plans for you guys when we meet physically next week, Saturday, by the grace of God. So those of you that have disappeared, you meet me in class by the grace of God next week, Saturday. You will raise your hands and close your eyes. Yes. Okay, then. Thank you guys for your time and understanding. I will see you again by the grace of God next week, Saturday, when we shall be meeting physically in class, one-on-one. Thank you, guys. Make sure you go through your material. It's very important because little by little, we are getting close to the D-Day. So this is lecture day number 2. All what we have done today and what we did in the lecture day 1, please put all of them together. Make sure you read and understand them. You don't accumulate. If you accumulate them, there's certainly for you not to meet up at the end when the exam is fast approaching. Today that you are hale and hearty, you are fine, you are good, you are bouncing, you are kicking, Please maximize the opportunity that you have, because you never can tell. Few days to the exam, malaria can set, anything can happen that will prevent you from reading. We don't pray for that, but maximize the opportunity that you have today. Utilize it judiciously. Read as if your exam is near at hand. God will make it very easy for you. Thank you guys for your time. I will see you next time by the grace of God. Bye-bye.
Bye-bye. Thank you, sir.
Thank you, sir.
You're welcome.
When are we getting the recording?
Yeah, thank you, sir.
You surely get it. I will send it to you today.